Treasuries are responding to this with a strong bid. And what we mean, bond prices are being bid up in this environment in reaction to both the JOLTS print last Tuesday as well as the non-farm payrolls result on Friday. It's continuing into Monday morning. US Treasuries are catching a bid, which means higher bond prices, lower yields. So if you look back on the chart, really going back to Q3, Q4 of 2023, where the 10-year tested 5%. We've been in what I would consider a very quiet, looks almost horizontal, but it is, if you ask me from a technicals perspective, it is downward sloping, um, uh, lower highs and lower lows on the aggregate for the 10-year Treasury. I put some markers here. This yellow bar here, basically going out to this higher high to begin the year in the 10-year back in January. This is basically the Trump administration's tenure. Now almost 3/4 in the books. If you look at the track record for the 10-year Treasury, it really is, in my perspective, it looks bullish to me. Yields are trending down with lower highs, lower lows in terms of yield over the time frame that this administration has been in office, which is really being driven at the top from the direction of Treasury Secretary Scott Bessent. If you remember, going into his commentary back in January, February, he talked about we want to be assessed by the results on the 10-year yields, and by all measures, after 3/4 here, the verdict really is showing success by that metric. 10-year yields are trending down, and this really juxtaposes with what's going on in the rest of the world. European sovereign debt rates are actually trending up on the course of the year, as is Japan. So that's a key data point I'd call out. Now, in terms of the bigger lower low on the cycle that still needs to be breached, which despite this rally that we've seen in bond yields or US Treasury yields, this lower low achieved at the end of last September when we got the growth scare and we got the first rate cuts of this cycle by the Federal Reserve at the September meeting of 2024. That low on the 10-year is still about 3.63%. We're at, as of about an hour ago where I took this screenshot, we're at about 4.06. So there's still room to go for this to really continue the overall downward trend of the cycle that's been underway since September of 2023. But as far as this administration delivering on what they said they would do, or what they would focus on and want to be judged on for whether they've been successful or not in meeting their objectives, the results are kind of lining up 3/4 in.
That makes sense. One question for you, Matt, on this is, you point out that lower low in your mind. Is that an expectation from the Trump admin that they want to get to that lower low point, or is that more of like a, looking at the broader picture, you're expecting to see that lower low be approached or maybe even breached on the lower side?
I would expect in a market you follow trend. Trend to me looks like bond yields want to come in. That doesn't mean it's risk off. Bond prices up can be synonymous with risk assets like equities, gold. Gold is not a risk asset. Equities and Bitcoin, stuff like that, going up. When I say gold is not a risk asset, it's not trading in this cycle like a risk asset. Didn't have a segment here on gold, but with the gold breakout this week, that is a key point to note. But from what I would expect as a trader, if you're looking at this chart, looking back on the long term, 12 to 24 months, it looks like interest rates want to come down. I would trend with still call it a primary direction on the last 2 years, even though longer term, if you go back to 2020 to 2023, 2023, it looks like the trend is up. This trend right now, where we're on the last 2 years, is clearly down in yields. Bonds are catching a bid. There is a move into treasuries. I'll go into some background on this old textbook that can give some mental models to understand why that may be happening. But my default assumption right now is just follow the market. Bond yields want to come in, lean into that. If you try to go into against direction of trend, you're asking for pain. And for all the bond bears out there who were correctly calling the problems, structurally embedded in the U.S. government's fiscal situation, that ZERP, QE, et cetera, were failing, not going to work, coming out of the COVID policies. Definitely were right, especially on the big bear move in yields from 2020 to September of 2023. But over the last 2 years, it's been the opposite. So this could be an intermediate kind of bid down, and maybe eventually yields do start moving higher. That looks for right now to be well off into the future, which means multiple quarters, potentially years away. But right now, I would assume just follow primary trend, and that appears to be down. And defining primary as like a 1 to 2 year, backward looking kind of window.